All right. Thank you, everyone, for attending this month's market update webinar for the month of July 2026. Let's start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and or tax professional before implementing anything within the presentation. And of course, past performance is not a guarantee of future results. You can read more disclosures if you'd like on our website. And throughout the webinar, feel free to use the Q&A button at the bottom, and we will address them at the end. A little bit about us. Silverstone Financial is a fee-only fiduciary independent wealth management firm. We provide various wealth management services, including financial planning, investment management, tax preparation, estate planning, and so on. You can learn more about us on our website. And then we got two hosts tonight. Myself, Jeremy Eppley. I'm a financial planner that specializes in inheritance and estate planning as such. And my co-host, Gordon Achtermann, who is also a financial planner who specializes more on retirement planning and values-aligned investing. We can probably hop right into the markets. So June was an interesting month. We saw a little bit of red finally creep back into the markets. We've had basically all green straight up the whole time since the Iran war was initiated. It sold off for a month or a month and a half. I don't remember the exact length of time there. And then since then has been up and up and up, recovery very, very quickly and hard. A lot of it has to do with the AI boom and euphoria around there. And then this month, probably there are a number of reasons, but perhaps because the Iran war has seems to have restarted or never ended, however you want to categorize that. So we see a lot of red. Specifically, we can see a lot of red in the mega cap names, so the largest companies: Microsoft, Apple, Amazon, Broadcom, Meta. They're down 5.6% for the month. The S&P 500, when you look at everything, being down about 1%. And then this is one of the reasons why we diversify is small caps. So smaller companies, some of these smaller boxes that you can't see the names of or anything, we're up 7%. So there's been a long trend for many years, but also somewhat recently where the mega cap names have really outperformed. All the money was flowing to the Magnificent Seven, soon to be maybe the Magnificent Eight, depending on your opinions on SpaceX, but it's definitely a very large company. And so the small cap companies, the broader part of the economy or the broader part of the stock market had been underinvested, and it seems like that has skewed back a little bit, and the pendulum has swung the other direction. We'll see how long that lasts, though. S&P GARP is growth at a reasonable price, one of our preferred metrics that also skews small cap, skews more value oriented rather than the really high flying growth tech names of the Magnificent Seven and the largest companies on the exchanges. So we see a little bit of gains on the smaller and the broader parts of the market. Global ex-US, that's non-US companies, were down 1.8%. So they had outperformed in recent history. And it seems like when people have been selling off, again, they're trying to swing the pendulum in the other direction, trying to find value in places that have been ignored. So that'd be my take on why global ex-US sold off at the same time as some of the mega caps. And then aggregate bonds up slightly, up almost 0.6% for the month. That's total return. And then the three alternatives that we track here: gold, crude oil, and Bitcoin, all down double digits, 12% for gold, and then crude oil and Bitcoin shockingly close to each other, down 20%. Interesting to see. So there seems to be a risk off. So I mean, selling your high flyers, your riskier investments, and going into some safer names, let's say. So the banks oftentimes, well, the banks are sometimes considered quite risky, but just in terms of a valuation metric, they usually aren't that expensive. The industrials, healthcare, utilities, that's where we see some of the green, and then a lot of the other high flyer tech names and communication names fell. Do you have anything you want to point out on this map, Gordon?
Yeah, I small caps really big story. They've just been consistently crushing, and so June has been no exception. Um, and then it's interesting to me when gold and Bitcoin both go down. Um, for a while, gold was really flying high, has kind of seemed to be taking away from the um, as a sort of dollar hedge. Bitcoin is sometimes called digital gold. But seeing both of them go down this month, a bit of a change of psychology, more broad um, loss of appetite for those types of investments. So that's kind of interesting to me psychologically.
Yeah, we'll get more into a story that might be the cause of that, but with Kevin Warsh as the new chair, and there was a lot of fear around him being, I suppose he'd be a dove, where he'd be more afraid to not cut rates than the expectation was that he would, do the president's bidding, versus he seems to be more of an inflation hawk than expected, or willing to raise rates or keep rates um, flat for
Hmm.
longer to combat the inflation with the war. And so that brings back some confidence in the dollar and some lowers the fears of inflation, which would make the dollar stronger and gold and Bitcoin less of a hedge.
All right. Well, don't steal all my thunder now.
Yeah, sorry. We're jumping ahead a bit. This
No
later
problem.
on. All right, year to date, we won't spend too much time on it. Much greener because this takes into account 6 months. So this is the first half of the year. Really, the big loser it seems like is the software names, Microsoft, some Meta. A lot of the stories with the software names having fallen was the fear that these SaaS models, the subscription, a software as a service model, um, might be disrupted by AI. Like, why pay Adobe or pay Microsoft for these subscriptions if you can go to Claude Code and say, hey, just make me the same software? Now, I think it's somewhat unrealistic and it might be a little bit of a overreaction. I don't fully believe that narrative, but that's at least what a lot of pundits or financial analysts or other commentators have explained why these software names are down. We see a lot of the tech names, and almost all of these, TSMC is Taiwan Semi, Micron, AMD, Intel, Texas Instruments, Marvell, ARM Holdings, Broadcom. Every single one of these are all semiconductors. I guess, yeah, this is the whole semiconductor industry now that I see it. So like this is the big winners, Micron being one of the largest winners in this half of the year. Actually, I don't think I see any on this map that shows a higher. I'm sure there's some biotech stock that beats it, but still, it's hard to beat 300% in half a year. Um, S&P top 50 up almost 4%, S&P 500 up 10%, and the small caps, that's the big winner there, the 23.6%. So you can definitely see that skew to the small is has been the narrative for this year so far. Global ex-US outperforming the S&P 500, so US stocks in general being less attractive, and then bonds up 1.2%. Not actually that great if we're talking about half a year performance annualized to be 2.4%. Ideally, your bonds are doing better stuff than that, but that comes down to inflation and fears of raising rates. When rates go up, bond prices go down, so your total yield or total return over that holding period will fall. So that has been dampening some bond returns there. Gold, we discussed before, crude oil up 21% for the year. There's a little bit of a reversion, but still, because of the war in Iran, it is quite a bit higher than what it was at the beginning of the year. And then Bitcoin, yeah, still down alongside gold there. Anything added on the year chart, Gordon?
No, I mean, just boy, still small caps. Also, well, I think with the small caps, maybe the story is around um, AI being implemented in some of these smaller companies rather than the producers, and just using companies that are getting return on investment on their use of AI so far. Um, Also, I always just mention we've got the emerging markets. Let's see, what are they up so far? 25.75 year to date as of today. Um, so really interesting there. That's just continuing the trend that we've been talking about for a while.
Yeah, that a lot of the emerging markets that's been skewed by specifically South Korea with Samsung, which is another semiconductor. So yeah,
Mhm.
definitely interesting to see all that, and yeah, we can probably move on to our next slide here.
Mhm.
So, average monthly returns. Love this graph. Or I think I see some new faces here. So, if you haven't seen this graph before, it's one of my favorite ways to explain the seasonality and cyclicality of the stock market. So, the outside circle is the historical average expected return month to month between 1950 and 2017. So, it is getting a little out of date, but it's still the cyclicality and seasonality in general holds. True to this day. And some of the best months you might have heard of the Santa Claus rally, where right after Christmas to New Year's, so there's oftentimes a rally. So December historically is the best month, averaging 1.6%. November and October helping the fourth quarter of the year, often being the best quarter. April being an interesting one here, where it's often performing quite well at the end of the first quarter. I suppose there are some earnings, and it might lead to better returns for that month. And getting into June, July, August, September, this is oftentimes the worst part of the year. Now, I always like to reiterate, we do not recommend trying to time the market or get in or out. These are averages, and averages have quite a large range. You could still be up 10% in September, and if you tried to time the market because of this graph, that would be a very bad investment decision. So just showing that we wouldn't be surprised if there's some inherent downside risk coming up, mostly because we've also had such a great run up the first half of the year. We're up 10% year to date. The average for the S&P 500 over the past 100 or so years depends on when you cut it up, but it could be like 7, 8, 9, 10%. It depends on the time period you look at specifically. But we already had our S&P 500 year return in the first 6 months. So we'll probably see some volatility, and it might still be up even higher at the end of the year. But we're in a good place. We shouldn't be stressing too much about hoping for more returns. There might be some pullbacks, and that's okay.
Mhm.
April followed the trend. It was the best month this year, and it's the best month on the first half of the year historically. But you can see March and February were down months that bucked the trend here, and then June often skews slightly down and was down. So just an interesting way to look at the markets. A lot of people don't see it as a seasonal trend, which there is a little bit today. All right, let's get into the stories. So I think we have three on this slide, and then we have five on the next. It's a lighter news month, but definitely some big impactful things happen this month.
Yeah, so I'll start here on Kevin Warsh. Um, he had his first press conference, and his communication style uh, different from his predecessor, Jerome Powell. shorter, simpler policy statement. Um, he seems to favor not predicting much about what's coming next, which that's kind of what he said he would do, and he calls it hand holding, um, which is when they talk a lot about the future expectations for interest rate trading and the dot plot, which is where the different members uh, put some kind of a prediction on where they think rates will be at various points in the future. Um, and so they held rates steady, no change so far. And as Jeremy was saying earlier, the um, there's always some kind of adjustment when there's a new person, and so perhaps his stance is a little different than what some people were afraid of, that he might be too dovish, and so I think that defending the dollar is absolutely, that's the main job of the Federal Reserve. Um, Trade changes in trade can make that a really difficult job, but so we've been the dollar remains the reserve currency, and he's gonna do everything he can to keep it that way, I'm sure, regardless of the president's preference. Um, the the fact is that what would really hurt the president even more, it would be if the dollar gets too weak. That definitely causes a lot of inflation. And so now that it's Warsh is his guy, it's maybe theoretically one less person that can be a fall guy for whatever happens in the economy.
This was a big, the change coming up with Jerome Powell, who I liked quite a bit, to Kevin Warsh was we've talked about in past months, but was a big stressor of mine. I was afraid of, the executive branch meddling in what's supposed to be an extremely independent agency that is nonpartisan and is trying to make best decisions for the economy. Kevin Warsh is now one of the most powerful men in the world. It's arguable that he might have some more power than the president. The Federal Reserve Chair is extremely powerful. And I listened to his initial press conference, and I was in general quite impressed. A lot of the fears were maybe not unfounded, because there was a lot of understandable worry around how much the president was involved in the process and how much he critiqued before. But I was, he inspired a lot more confidence, and that he wasn't going to sledgehammer destroy everything at the Fed. It was more so, tweaks, and I may or may not agree with the tweaks, and but overall, I thought he had good points and was logic based and was measured and all that kind of stuff.
Hmm. And, there are other things on his plate besides the every 6 weeks interest rate decisions and meetings that they have. He's interested in improving Fed communications, balance sheet policy. I think we talked about that last time around, like, okay, are they gonna reduce the balance sheet? That is the debt that is on that the Federal Reserve has.
He's a big proponent of that, yeah, and I somewhat agree with him. I think that makes sense instead of interest rates. His explanation, which is a good one, is the debt that gives liquidity. So the Federal Reserve buys a lot of U.S. Treasuries and such, and it props up a lot of the bond markets. That tool that they use, where they can buy or sell these bonds in their balance sheet, it helps everyone, but it disproportionately helps more those with assets versus interest rates. Changing those can affect borrowers of like on car loans and credit cards and such. So I'm he makes a good point. There are some things that I so far am cautiously optimistic about his points, about his viewpoints.
Yeah, it's always the question of if you use up all your ammo, then what happens when the next crisis comes around? So um, the balance sheet where it stands right now isn't a problem, but if there's another financial crisis, the pressure could be to increase it again, where it has never come down from the big borrowing that happened in 2008, 2009. So
Yeah.
um, just for that reason, I agree. I'm in favor of balance sheet reduction.
And it's trillions of dollars. Like it's hard
Yes.
to comprehend how large the Federal Reserve's balance sheet is. I forget how many trillions. It's like six or eight or something ridiculous.
It was 6.5. And then with COVID, I think it went up to 8-ish. Yeah. Um, so the next story here, Lisa Cook. So this case went all the way to the Supreme Court. President Trump wanted to fire her. There were accusations of mortgage fraud. Um, as I've said and will continue to say, it's not a crime to have more than one primary home. That just means that you're not that your second home is not something that you're renting out for, um, for rental income. And anyway, the Supreme Court said that he can't fire her except for cause. And basically, this is in the context of their simultaneous decision where they basically granted the president very broad authority to fire heads of other agencies, the Federal Election Commission, the Federal Trade Commission, all kinds of things that were described in the statutes that created these agencies were described as independent. Um, so the argument against, um, the argument for keeping the Fed independent, why doesn't it also affect the other agencies? That's a question that I don't have an answer on. But um, to come back to the independence of the Fed, definitely a good thing. Um, Federal Fed boards, the Federal Reserve's independence is really, really important to our economic security. A lot of countries don't have that, and consequently, their currency doesn't have the faith of investors. So it's definitely a victory that, in my mind, it's definitely a victory that Lisa Cook is staying on.
A lot of it also just making it very clear there wasn't substance to the firing. He just wanted her seat, and
Yeah.
not getting too political with everything, but trying to fire her for alleged, you know, uh, was it mortgage or it was mortgage
Yeah.
fraud or whatever,
Hmm.
is very pot calling the kettle black with him actually having been convicted of that kind of stuff. So it's a lot of ironies that at least the Supreme Court was able to see through.
Hmm. Um, and then the third one today here, also Fed related, Alan Greenspan served as the Federal Reserve Chair for 5 terms, um, passed away at age 100. Really, a guy with a lot of energy. I remember, when he was in his 80s and finishing out his term at the Fed, um, he was dating Andrea Mitchell, I think it was, who's a reporter for ABC and considerably younger I mean, not extremely younger, but definitely younger. And I always admired his energy and um, his detailed and almost artistic way of explaining things that the Fed was doing and his thoughts on the economy. Um, some people would say that what happened, part of the cause of the dot-com bubble was an overabundance of money supply in 1998, 99. People were very worried about Y2K, which for anyone younger than 30 probably doesn't remember that at all. Um, but there was a code bug where the backbone of our financial systems was mostly written in a programming language called COBOL, where they only used two numbers for dates. Like 1997 would just be coded as 97, and that had to all be fixed and switched on in time for the turning to the year 2000. Companies needed a lot of money to make that fix, and so they kept the money supply very high, kept a lot of liquidity in the markets. And then when Y2K passed and nothing happened, um, we had the dot-com bubble. Um, that was just one of the causes of the dot-com bubble. But so Greenspan's my larger point, Greenspan's terms were not without difficult periods, but his power and the um, cult-like status that was given to his press conferences when the Fed would come out with interest rate decisions was a high watermark for the power of the Federal Reserve. He was respected by people on both sides of the aisle. Started in the Clinton administration as chairman and went through deep into the Bush administration before Ben Bernanke was his successor.
Yeah, I think it's great to get to the round number of 100. I think that's the goal. If he passed away in 99, I think Charlie Munger was off by 30 days or 35 days, something like that. I would be a little bummed. Of course, I suppose dying, you'd be bummed either way. But yeah, the goal is to get to 100. I hope for everyone on the webinar. Anyways,
Well, my grandfather lived to 95, and that seemed plenty old at
that's
the
fair.
time. But yeah, it's the life in your years more than the years in your life, right? That's what I
You
like to
probably
say.
you probably don't care as much about round numbers when you get to in the 90s. It's probably all the same to you versus in your 20s or 30s or 40s. A round number might be nice to strive for.
Well, I do think that, the studies are pretty consistent that as people get older, they get happier. At some point, you realize you have enough and you're ready to, letting go of expectations and things is good for happiness. So, um, yeah, I want everybody to live as long as they can enjoy um, that mindset, and Greenspan certainly did.
So for our last slide here, just some more notable events. These are all mostly specific to companies, all large news items around the biggest one, of course, being at the top here, the SpaceX IPO. We had the largest IPO in history. We talked quite about a lot about it in our previous webinar. We made a whole 20-minute YouTube video, which you can find on our YouTube channel, Silverstone Financial. Go check it out. Like and subscribe, all that stuff. um, and we dig deep into SpaceX and why, in general, we weren't a fan of the IPO, at least from an investor standpoint. But yeah, it was interesting to see. It surged 20% on the first day. It closed around 2.2 trillion or something, and it's been fluctuating quite a bit since then. I think it IPO'd around 150, 160, and then it shot up to the high 70s, low 80s or something, dollars per share. And then it went back down very close to IPO price, 155 or something. And now it's back up. It might be down today. I don't know. It's going to do what it's going to do. And in general, it's an unprofitable company that to make an investment case in it, you have to really believe in Elon specifically. And if that is you, you know, look into the company. If it's not, you could probably move on without worrying too much about it.
Yeah,
Another, oh, go
I'm
ahead.
I'm a skeptic on SpaceX. It went down, I just checked, down 7 something% back to 157
Today.
today.
Mm.
But it's really interesting. People have strong feelings about it. And we'll definitely be following it closely.
Also intriguing was an article I saw that it was about Schwab's U.S. large cap value ETF, and it has about 15 billion in the exchange traded fund. And again, it's a large cap value ETF. So when it's a fund that is labeled as value or growth, or you know, you can label it various different names to it. Value usually means a highly profitable company that doesn't have that much growth tied to it and pays good dividends. That's usually what you think of, low valuation. That can be very valuable, but per share, low valuation. Um, that's what you think of when you think of a value company. And I can't think of anyone with a straight face making the case that SpaceX is a value company. It's not profitable. Its price to earnings ratio is non-existent because it's not profitable. Its price to sales ratio, which you know, just getting into the finance weeds of it, the finance nerd in me wants to dig into it and tell you all about it. But basically, it's a very expensive company for what it is. And even with the growth tied into it, uh, it's extremely expensive. So it, in no traditional finance sense, is a value company. Yet it still showed up. It was placed into the Schwab large cap value ETF. And so it's a very tiny percentage of the fund. It's 0.012% of the fund. And it's a very, very small holding in it. So it's non material. But it brings a bigger discussion to the board where we're talking about what is SpaceX going to be doing in lots of these funds, especially the index funds. We have it's a large part of the YouTube video that we have of what various indexes is going to be a part of. I think already it's a part of the Nasdaq 100. So that's the triple Qs, QQQ, if you hold that fund. That will have SpaceX exposure. Right now, S&P 500, it was feared that it was going to be fast tracked with the S&P 500. Even the S&P 500 has profitability screens, and it's not a profitable company. And so far, that was the fear. And S&P Global, the company that manages the index, said that they aren't fast tracking it, but they could still see it. We could still see SpaceX maybe join in 2027. And there are lots of other indexes and other funds that are adding this company. And again, depending on your specific investment style or criteria or preferences, it may or may not be something you want in your portfolio. We do direct indexing with almost all of our clients, where clients can choose what stocks they want to include and disallow. So instead of buying 500 stocks within an ETF wrapper, and you either buy it or you don't buy it, we can buy 500 shares, 500 stocks, and then if you don't want two or three of them, we can remove them. So it's a nice customization that some of our clients really enjoy. Anything to add to all that, Gordon?
The Schwab thing is really interesting because that fund is actually supposed to be a passive fund, but their own thing said, "Oh, it was a symbolic chance for people to own part of this big company. It's like that's exactly what a passive fund is not supposed to do. It's just shocking to me. But
Yeah.
maybe I need to be more cynical if that's
Yeah,
wrong.
like if you buy a passive fund, the goal, is it follows the prospectus, and the prospectus says we follow these rules, and there is no human emotion in it. And then, you see them not follow their own rules, or
Hmm.
as at least advertised to clients. I'm sure they have the legal right to do so, otherwise they wouldn't have done it. But
Right.
like usually, a lot of the prospectuses say like 85% required in this style, and then it gives them wiggle room in case they have cash or other things that they need in there to make it work. But still, it definitely makes you question all the funds, just the methodology behind a lot of it, which we're pretty rigorous in when we build our portfolios and figure out which funds we include with clients. We try to pick the best funds, at least in our opinion, and what we're screening for. And yeah, it definitely gives a ding to Schwab funds in my mind. Plenty of other funds are doing wacky stuff as well, so let's not hate too much on Schwab. All right, moving on. So we have two big announcements for the changes in the S&P 500 and the Dow Jones Industrial Average. Both these are widely followed indices. The Dow Jones Industrial Average has lots of problems that Gordon and I both, we don't usually follow the Dow Jones because of how it's priced and lots of other things. It's only 30 companies, and it's price weighted, and there are lots of problems with the Dow Jones. The only reason it's still used is because it's so old and people have gotten used to it. But anyway, Marvell, which is a semiconductor company, essentially, they do various things. They are knocking out for the 500th slot in the S&P 500, a company called Pool Corp, which most of you probably don't know, but they are just a major supplier in pool supplies and equipment for U.S. and internationally. They're just one of those companies that makes a lot of stuff that if you have a pool, you probably use, but don't know that it's made by the company. They probably also have lots of brands, and they compete against themselves, and it's a whole thing. But now apparently Pool Corp is the 501st company that in the list, so it's getting kicked out of the S&P 500. And Marvell is being added. They're now profitable enough to be included in the index, and that has to do with a lot of the AI fueled investment and buying frenzy and such. Not much to add, but yeah, we do like to mention it whenever they reconstitute the index, which happens every so often. And then the other big one, which I think is the bigger news, even though I'm not a fan of Dow Jones, is that Google is joining. So Google, the parent company Alphabet, is joining the Dow Jones, replacing Verizon. They're both communication services companies, but of course, Google is a better company, if I'm allowed to say that. It's definitely more profitable, had more growth. Yeah, I can't think of a better word than better. But not necessarily trying to make specific investment recommendations here. Google replacing Verizon makes it the fifth Magnificent Seven member included in the index. So Amazon, Apple, Microsoft, Nvidia, and Alphabet are now all in the Dow Jones. So they're 1/6 of the index by names. They might be weighted slightly differently, and they have a weird weighting scheme. So I'm not actually sure how that all fills out. Meta and Tesla aren't in it. I think it'll be unlikely for either of them to become in the index in the future. One, because Tesla is not value, like it's too unprofitable relative to its value for it to fall into the Dow Jones usually. That's my expectation. And then Meta is in the same in his same industry as Google, and Google is the larger, more profitable big brother of Meta. So just from a weighting standpoint, I believe how they do it is they try to pick from various different industries, and so I think Google will always beat Meta unless there's a big shift in the landscapes long term. So we're probably sticking with those five until SpaceX comes and says, this is a new industry. We're space. You got to add us. So that'll probably be the sixth one day.
Interesting thing to me about Marvell is when we were on our heat map there, Marvell is a visibly big enough square in there. Um,
Right here,
yeah,
MRPL.
yeah. So, it's clearly it's not the 500th, but there's a delay where there's kind of a confirmation that has to happen, right?
Which is a good
It's
thing.
not
Yeah.
just the 500 biggest, it's the ones that have been in that range for a while. S&P, it's kind of like a year look back or something, but yeah, Marvell is up a huge percentage this year. I think it's 220%. So the nice thing about the S&P is that it doesn't just swing with every breeze that goes by.
Yeah.
And that's why it's the most representative of the U.S. economy.
Yeah, that's some good nuance there. Yeah, it's definitely not the 500th in terms of value. What specifically allowed it to go in, I have it in my notes here, is that it now meets the gap profitability bar that
Mm.
the S&P 500 has. And it didn't before, and now that it has been profitable for a long enough period of time, which I don't remember the rules for specifically, but it's been profitable long enough and they're like, okay, you're in. A lot of it, the profitability came from this AI boom over the past year, 2 years, and so it knocks out Pool Corp, which seems to be, I think, the 500 first in terms of size, but it also might have been its own, like it's not profitable enough recently, kind of thing. So, yes, that's a good nuance of it's not necessarily the size, which I did not clarify, but yeah, Marvel is now in, and Pool Corp is out. Sad
Mhm.
day for all of us who go to pools, especially in our 100-degree weather right now. So
GAAP, by the way, that's generally accepted accounting principles, and that's just gives a consistency when people are saying, "Oh, we made this much money," when you do the quite involved calculation to come up with a GAAP number. It ensures that you're comparing apples to apples.
yeah, there's a we're getting into weeds, but we've opened the box, so I'm going for it. So I went through my CFA education, which is almost in many ways an accounting degree, where you go and you have to manually recreate balance sheets and such for companies. And what's ridiculous about the education for that one is you have to learn the different processes for IFRS, which is the international reporting
Ooh.
standards, and the US GAAP reporting standards. And you have to memorize the formulas. And the formulas are the exact same, except for one's like a minus sign and one's a plus sign on like this multiple thing because they just some exclude some things and some add some things in. And it's a whole mess. Anyway, yeah, so US GAAP definitely ingrained deep in my brain, even though I'm trying to erase it as hard as I can. Anyway. Anyway, moving on. Um, so honestly, I want to end on NVIDIA. So I'm going to skip over NVIDIA. I'll come back to it. So the Fox buying Roku. Fox has agreed to buy Roku for about $22 billion in a cash and stock deal valued at about $160 per share. There's a lot of potential reasons behind it, and it's still pending regulatory and shareholder approval. I would guess it would go through. I don't necessarily see why. I don't think they're large enough independently that it would be antitrust, and I don't think that this administration would try to block it. But the a lot of analysts are saying the deal behind this is Roku. For those of you that have TVs, a lot of times are on the more inexpensive TVs. You don't usually buy what are called dumb TVs anymore, which is just a screen, and then you have like a separate media player. It's a smart TV where it has everything inside it. And one of the least expensive ways for a TV manufacturer to get good software on their TVs is to have to partner with Roku, and Roku give them the software for free. And then Roku usually makes most of its money off of advertising and trying to drive people to watch specific content on their own TVs. And So it's really it's a software advertising company. So this is really what it is. It makes the software to make a lot of TVs run. You might have a Fire Stick, you might have an Apple TV, you might have a Google TV, or Samsung. I think those are the main rivals of who makes the software to make your TV run. Roku is another one, and so Fox buying it. There's a lot of expectation that Fox is buying it specifically so that they can encourage or drive or push people to be like, oh, well, I want to watch the news, and the default news option is Fox. And so it's a lot of that kind of stuff. Fox also has lots of other entertainment other than Fox News, but trying to push their own content on these TVs. And people don't really have a choice because most people buy an inexpensive TV. It comes with Roku, and you're stuck with it. You could, of course, plug in your own, Fire TV stick or Google TV stick or whatever you want to try to change the operating system. But in general, people don't do that, and they pick the cheapest, brightest TV because that looks good to them, and they don't want to try to discern the various pixels and try to do all that kind of stuff that TV nerds like to get into. So it's definitely interesting, and we'll probably, I would expect to see it go through, and it probably does make sense for Fox, depending on your political leanings and if you want Fox News to be more prevalent in the world or not. You might favor or dislike this deal, but that is the business case behind it.
Well, as somebody who owns a dumb TV, and we have both a Fire Stick and Google Chromecast, um, it's not that hard.
Yeah, it's usually like 80, $100 to buy them. So if this really bothers you, you have a Roku, you don't need to switch the whole TV. You can go and buy one.
I don't think we paid anything for our Fire Stick when if you have Amazon Prime, I mean maybe you do now, but when we got it, it was just like, you know, came with the Prime membership.
Interesting. I hadn't heard that. Yeah, I would be surprised if they're still doing it. It might have been when they're trying to really push Amazon Alexa and the Echo. And sorry if I just triggered all your,
Yeah.
but trying to get people into the ecosystem, maybe they're giving away. But I haven't ever seen that promotion. But maybe it's still going. You just have to look for it. Nah, I don't know.
It's been I don't know 5 6 years since we did that. So anyway,
Yeah, we use I have on my TV the Google one that's built in, and then my mom has a dumb TV, and we have a Google TV puck that goes in. I think it was 50, 80 something dollars. I
yeah,
don't know how much what
yeah,
the pricing is now,
yeah.
but
They're
they work well.
usually yeah.
All right, last item here is Nvidia is raising 25 billion in corporate bonds, and it's the first time they've done it in 5 years. This also comes after, I think, last month or 2 months ago, Google also raised money. I think they did a century bond, a bond that matures in 100 years or something like that. I forget exactly if they did that or not, but Disney, I think, was the first to do that back in the 70s or 80s or something like that, 90s maybe, where you're basically borrowing money beyond people's lifetimes, which is very interesting to see. You can go back to, which is now I'm on a tangent again, but you can go back to some of the debts and the bonds for, like, in England specifically, where you have perpetual bonds. I think it's like Denmark or something like that lost some war, so they have to pay them perpetual bonds, which they're still doing, and they have to pay them like $2,000 a year or something like that. And there's someone that has to write the check and someone that has to deposit the check. And it's like in finance, there's easy math. It's called evaluating a perpetual contract. And I could do it in 3 seconds of like, what is the value of that cash flow into infinity? And then just send them a check for like $40,000 and don't have to manage it every time. So it's silly to me, these perpetual things. But that's my tangent. Sorry.
Yeah.
Um, the anyway, 2025 billion. There's some reasons that they give for why they're doing this bond issue. One is, of course, they're trying to produce more cutting edge chips, and they're trying to make this money to get this money to continue the production. And they're also trying to consolidate some of their older bonds and trying to refinance it and establish, basically a liquid benchmark, they call it, for the cost of credit for them. That's getting into the weeds. What I really wanted to talk about here was what it says about interest rates and what it says about AI. And so when we see these uber, hyper, mega profitable cash cow printing companies of NVIDIA and Google, all right, they each have billions and billions, I think 100 billion or something like that each, in just cash already. And they're just going out and saying, all right, the market says I have to pay 5.5, 6%, or whatever the number is to get bonds, and I can lock in this interest rate for 30, 50 years, whatever it is. And even though I'm printing another 200 billion myself just for my business, I'm going to go and borrow this money. And it's possible that they're borrowing the money. And if they're continue to be this profitable and they don't actually need to reinvest it, they could go and buy back their shares. And it comes in finance called cost of capital, where you can finance your company either through equity or through bonds, and you can either be 100% debt or 100% equity, and there's a blend, and there's an optimal, there's a whole lot of stuff. You're getting to the finance weeds here, but trying to buy back shares and convert fixed payment to these bondholders to increase the returns to shareholders. Essentially, you're leveraging up your company and trying to increase the return on equity. That's the back end side on the accounting side. And it's interesting. I think it says that one, the AI boom is sustainable. If they're willing to take this money, they think that they can pay back. Two, that they're printing so much cash and that the investments are so high that even if they're making 200 billion, they still need another 25 billion to be able to pay for all these chips and all this other stuff. So like the investment is ongoing. It is bigger than they expected, and that there's the returns that they are expecting for them to continue it. Because if they ran out of cash, they would usually just stop. But here they want to continue, so that's interesting. And the third or fourth point there is that these current interest rates are too low, which is interesting to say because we raised interest rates and then we lowered them, and now inflation's coming back, and the thought is either keeping them flat or raising them. And we'll have to see what happens, but it is interesting to see that companies, at least, are saying these interest rates are a good deal, and that tells me we might see interest rates go up. I don't know. What are your thoughts, Gordon?
Well, I think that with NVIDIA, there's one other angle that I'm interested in, and that is the challenge of competing with China. I think that NVIDIA has the best chips for AI for most of these purposes, but they want to spend and continue the research as much as possible in order to stay ahead. They are not waiting for China to catch up. China has a stated goal of, getting their domestic manufacturing to surpass NVIDIA and surpass Taiwan Semiconductor, and they're putting a lot of money into it. And as we know, China has a trade surplus. So that means they have hard currency, they have dollars and euros to pour into their development efforts. And they are starting to invest more and more in basic scientific research and not just being content to follow along and make a cheaper version of things that are invented in the United States. I think NVIDIA is rightfully worried about the medium term, really, the medium term challenge of China.
Yeah, good points. All right, I guess
Google, I don't know. I don't know why Google is doing what they did with their bond sales, but
well,
yeah.
Google needs to buy a lot of chips versus like NVIDIA selling the chips. Of course, Google makes some of their own stuff and designs their own stuff, but since they're one of the actual AI providers,
Mhm.
they have to build out the compute for themselves. Versus NVIDIA is happy to sell them. So I found it interesting for NVIDIA.
Yeah.
All right, well, we're getting close to the hour mark. We had two, at least so far, Q&As that came through that I'll read out, and Gordon and I can address. So the first one was asked was how should retired people alter their plans considering increased inflation, Social Security, trust fund exhaustion, and exploding national debt? How would you respond to them?
Well, I think that when it comes to the debt, we know that the debt is too high when inflation accelerates for no other reason. Um, and the inflation that we had in the COVID area, that was supply shocks. And some of the inflation reacceleration that we're seeing this year is because of the oil prices. Petroleum is an input to so many industries, and there's kind of a lag of how long it takes those higher per barrel prices we saw. So I think that we have to keep an eye on high debt. It's a bad sign when you have high debt, even though the economy is growing. Um, we COVID is a good reminder that when unemployment spiked because of COVID, we had like 20% or something at one point. Um, and so you need to use deficit spending to stop that from spiraling out of control. It was a Keynesian kind of approach, but in extreme employment crises, that's what works. It's been tested more than a few times. And but this debt is during a time when we don't have a particular crisis in terms of employment or growth. And so it is worrisome. Uh, but we have, if you have done a financial plan with us, we've tested it according to, what if growth is lower than we thought? What if inflation is much higher than we think? And we don't change our plans just because of potential things that haven't actually come home to roost yet. So it's similar with Social Security. Like, yeah, if there's no legislative fix, then Social Security will have to cut benefits by 15% or so. Um, that would be bad, but most people only get in the areas where most of our clients live, they get maybe 40% or less of their retirement income for Social Security. So 15% of that, it would hurt, but it's probably not going to completely derail a financial plan the way that some of the other things we have to plan for could, like long-term care emergencies. Um, you know, uh, yeah, health is definitely the most unpredictable and potentially devastating problem that we plan for. But we're 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 always asking ourselves, what if? And these things fall into the category of things that we're evaluating when we do plan.
Yeah, I would agree with most of it, especially if you have a plan with a financial advisor. All these outcomes are already stress tested and assumed in the plan. For inflation, like that usually is built into the plan. Also, Citrus came to say hello if you see her on the side here. With inflation, there are a few things that can be done, and talk to your advisor if you'd like. But like sometimes inflation protected bond or inflation hedged bonds, or having other kinds of the gold or the Bitcoin, which haven't been doing that well right now, or stocks in general help with inflation. Social Security fund, it's just you have to have that stress tested. You can have more bonds in your bond ladder to account for that if you're trying to plan out cash flows and such. And then exploding national debt, there's not much you can do about it except for try to vote for different Congress folks, but it doesn't like both parties seem to be happy to spend mortgage and spend, mortgage and spend. So it just on different things, whatever their priorities are. So yeah, the national debt's going to do what it does, and if it's not going to blow up, or it will blow up, and there's not much we can do. I've often said, my generation around our retirement is probably when the national debt will become a problem. For those that are in retirement, I don't think we'll get a problem for in your lifetimes. We'll have to see. But yeah, there's not much you can do because treasury bonds are the basis of everything in finance. Everything is priced to treasury bonds, and treasury bonds are considered risk free. So, like, if the government can't pay its debt and the national debt blows up, then your risk free thing is now risky and everything breaks. So there's not much you can do. If you are afraid of society collapsing, talking with a financial advisor is probably not your best bet. You should probably go water, bullets, and guns, and get some training with a marksman. That's probably your best bet if those are your worries. But for a financial plan, inflation, Social Security, we got you covered. All right, second question, and last question. I don't see anyone else coming through here. Is what is your view on investing in cryptocurrencies such as Bitcoin for retirement portfolios? I guess I'll start on that. I think Gordon and I have slightly different opinions on Bitcoin. He's written. You can go on our website, on our blog, if you want to read it. He's written about the case against Bitcoin. We do have some Bitcoin in our client portfolios, at least our base case client portfolios, our model portfolios. And it depends on how aggressive or risky you want to be with the money. But the high end for us is like 2.5% of the portfolio would be in Bitcoin and 2.5% would be in gold. So that's like 5% to alternatives. So if you are planning on investing in Bitcoin or cryptocurrencies in a retirement portfolio, like keep it a small percentage and understand the risks that it could go to zero, it could go very volatile, it can do lots of things. It is an asset that isn't fully correlated to the rest of the stuff, the rest of the stock market or bond market. So it's interesting. It's definitely curious, and we have a little bit of exposure. But there are clients of ours, and Gordon would be one of them in his portfolios. He just excludes Bitcoin and just doesn't want it in his portfolio. He doesn't want exposure, and we're perfectly fine with that. Doing that for clients, or recommending it if they just don't like it. It's such a small, 2.5%. It's not going to change your overall outlook from I guess a younger advisor's point of view, looking at 20, 30, 40 years down the road potentially. I like seeing some exposure. Some of the other like Ethereum and all the other cryptocurrencies, NFTs, throw in whatever you want. I'm not a big fan of it. Bitcoin specifically is structurally slightly different. But yeah, Gordon, anything to add?
Well, yeah, I am a Bitcoin skeptic for various reasons, but 2.5%, that's not gonna break um, anybody's whole retirement plan any more
On the high
than
end.
you know if you plenty of people who have um, company stock. Maybe you worked for Northrop Grumman or something for a long time. Um, then you may have a similar amount of your portfolio in that one company, and there are ways to hedge that. So, um, as long as you're not overweighting that particular bet, then you know that's I can work with that.
Yeah. And as I said, that's the high end, the 2.5% for at least what we're comfortable recommending to clients. Like some people are 1% or 1.5% or a zero. Again, it's perfectly fine. I wanted to add one thing that I saw a message come in that I thought it was funny is he said to summarize, avoid Bitcoin, invest in poly market. And I wanted to say something here because Gordon and I had this discussion this week, and like a legitimate, just like an interesting thought process that occurred to me. Going back to like the firing Lisa Cook story, where Trump was not allowed to fire Lisa Cook, but was allowed to fire basically every other independent agency's heads, is like, say you are the person that is the head of this independent agency, and your livelihood, your salary is dependent on an election outcome. And again, this is not financial advice. I'm not saying you should do this, but say that's you. Okay, you actually your job depends on who is in the White House, and you want to hedge your bets of, okay, say is Biden versus Trump again, and say you're a Democrat in as one of the heads of these agencies, and you're making $100,000 a year. Like maybe you want to hedge your income and bet for Trump that Trump would win. So again, you're not hoping that he would, but you're hedging your bets so you get some compensation in case something the downside occurs on you. Like maybe a poly market or a Kalshi or whatever these betting markets, might actually be a hedge. Now that's not a recommendation, but it's interesting to see as these betting markets become more and more universal, let's say, and more integrated in the financial system. I could see more and more of these, like, it doesn't have to be political. It could be, betting on various weather outcomes for if you're a farmer. You already have those kinds of contracts that are derivatives and such in finance, but there might be interesting ways to use these poly markets and Kalshis and other parts of the world. Now, with that said, in general, avoid. Sports betting is not investing, all that kind of stuff.
The problem is, though, with the political outcome, it's roughly 50-50. So if your potential loss is, let's say you want to hedge 2.5 years of income. Well, a political appointee makes around 200,000 a year, so that would mean you'd have to make a $500,000 bet, which nobody wants to bet that and lose. I mean, if you're kind of guaranteed, you're locking yourself into a lose-lose then,
Yeah.
almost.
Well, like you don't have to fully hedge it. Some people do partial hedges.
Yeah.
Another thing you can do is, again, not advice, but I would not be surprised if in the next 2 years, because of how much people like leverage and risk, is I could see leveraged contracts and stuff like that. Like go on Robinhood and say, okay, I want a 3x leverage bet on Trump winning. You could find a way to do leverage bets that have downside protection somehow. I don't know. I would not be surprised if they made derivatives of derivatives of derivatives. We saw it in 2008. It'll come back. Interesting.
Yeah.
We're having a little fun here. Especially this Q&A portion is not financial advice. The whole thing is financial advice, but this Q&A. But anyway, anything to
Very good.
add, Gordon, or are we gonna wrap
Uh,
up?
no, great show. Thanks.
All right, we went over by about 10 minutes, but hopefully everyone enjoyed the Q&As. Thanks everyone for coming. We'll see you in August, and hope you have a wonderful July and July 4th.
Take care.
Bye bye.
Bye.